morning and welcome to Fast Market. It's Wednesday, April 17th. I'm Alex Coffey and I'm joined on set by co-host of Fast Market, Kevin Hincks, and by Scott Bauer, CEO of Prosper Trading Academy. Thanks for joining us this morning, Scott.
Always great to be here, Alex.
Scott Bauer in the house.
In the house.
How we doing?
Interesting morning so far, Kevin, though. Do you want to set up the action? We started out up a little bit more than we are now.
Here's what I think is the underlying theme, and it has a lot to do with what we saw yesterday with United Healthcare. I've been combining these two for about 24 hours now, Scott. Think about it. Both companies, good earnings. Both companies, uncertainty in their futures. Both companies opened up and have sold off since then.
Yes.
So, and we talked a lot about this, that was the risk in Netflix. And sure enough, up $10 overnight, now down on the day.
Though it did start off down, what, 3-4% quickly, rallied back and now unchanged. Boy, a premium sale or an iron condor sale would have been, just fantastic in that. But you're right. I mean,
would have caused you some gray hairs. But
no doubt about it. You got a big range, but here we are unchanged.
Yeah.
But you're right, Kevin. I mean, everything we're seeing here in these big names are not so much about earnings. It's all about what's happening in the future.
Yeah, United Healthcare is the healthcare sector. United Healthcare put out good numbers, but the overall uncertainty about the healthcare sector is weighing on that. Netflix, it's the competition, right?
Yep.
Even though their numbers they put up good numbers, good subscriber growth, it's the uncertainty about their future.
Hard to fade Reed Hastings.
Yeah,
Exactly.
we'll get into Netflix a little bit more in just a second, because we did trade it though. But Scott, I think he hits the nail on the head on why we're seeing this reversal intraday. As far as the future started up in the S&P is about 10, now they're down about 4.25. It really is the healthcare space turning around, and you're seeing United Healthcare again quite a bit lower. But also we had some conflicting information too. We also had some good news out of the China talks. Maybe that was boosting us early on. But
China GDP
I was going to say, not just the China talks, but China economic news over the last few
2 days
weeks
in a row
so,
now.
has been pretty strong.
China GDP rose 6.4% in the first quarter, which was faster than they expected as well. Industrial output and retail sales for March also beat out of China too. So we're starting to see the data overseas firm a little bit. We're starting to continue to see those trade talk conversations going well, but we're getting conflicting stuff over here that's kind of offsetting that a little bit. But putting in perspective, we're up 15%.
No real damage done to this
We're up over
market.
20% in the NDX, and we're just a couple percent from making new highs, Scott.
No question. And you know what? I think we're going to get to those new highs. I really do. And unless, something in the overall marketplace comes out where the tariff talks just they leave the table. Something like that, or some big phenomenon on Brexit, which that doesn't seem to be the case anymore. I think we're going to get to those new highs.
Yeah, they kicked the Brexit down the can down the road a little bit here. We also got a couple pieces of economic data this morning here domestically. Nothing huge, but I think it's worth mentioning. The international trade, the deficit was quite a bit better than expected, coming in at minus 49.4 billion versus the 53.6 deficit that they were expecting. And also MBA mortgage apps. We don't talk a lot about that, but we're starting to see a little bit firmer data out of the housing market. 7% was the year-over-year gain, which is a positive indication for the April home sales.
Well, we better see it with rates down here, right? I mean, if people aren't taking advantage of where mortgage rates are right now, I don't know what's up. But also keep in mind, overall in the marketplace, low volume this week because of the holiday, no trade on Friday. So, that could also be playing into some of these intraday swings that we're seeing.
One quick thought here on the international trade number. Why is that important to the people watching the show and our viewers out there? Because GDP, first quarter GDP, that number, so much stronger than we thought, should start to ease up the expectation for first quarter GDP. That's why I think that number beating so much is important.
No, I think that's a good point, and you see it's continuing to, kind of get closer and closer. It's better than it was prior, and it's significantly better than the estimates.
Yep.
But let's pivot to a little bit more stock-specific stuff, because we did have some trades we put on. There was earnings, obviously, between yesterday and today. Morgan Stanley, we did not have a trade on, but if you pull that up, that's I believe it was roughly unchanged last I saw it here, Kevin. And yeah, we're up actually a little bit now. So you're seeing some strength in the financials again on Morgan Stanley, as they actually came out, beat EPS pretty significantly, and actually beat on revenue too, which we haven't seen out of some of the other banks, as it was more focused on cost cutting so far this quarter.
No, Morgan was a real good one, and it wasn't blowout, but it beat the lowered expectations that were out there, and that coupled with the interest rate environment and the rise that we've seen in rates over the last few weeks, is really helping some of these big banks.
Not to mention, there's a big relief rally going on right now in some of the financials because the numbers are not turning out to be as bad as everyone thought. And Goldman got upgraded this morning, so that's another nice big upgrade. But all in all, I think I call this financial rally kind of a relief rally.
I think it's a good point because they were so depressed, especially with the yield curve compression that we've seen. But the big story we kind of mentioned already is Netflix. And crazy volatility so far with the earnings announcements. If you look at where it initially came out, as far as the announcement, it was down about $30. You saw it rally up to up 15, up at least up 10, and now about unchanged. And as you mentioned, Scott, if you sold the Iron Condor in here, if you sold a Strangle, you did anything where you're selling premium, you're likely celebrating today if you were able to wait and to see where this opened. But we actually put on a trade. There's nothing to do yet. We do have a little bit more time. We did it small, more of a speculative play based off some of the data that we had and kind of what we've seen with Netflix. And we actually bought a downside put Butterfly, but it is for next week, so we have a little bit of time. We would have liked that original move that we saw, down a little bit more. And one thing you mentioned on Netflix too, Kevin, I think it's worth mentioning is the uncertainty going forward. If you listen to what Reed Hastings said at Netflix, he basically said, we don't have that much doubt. We're doubting Apple and Disney's ability to come in and make a material impact on our business. If you wanted to hear something out of the CEO, that's probably what you wanted to hear when it comes to Netflix.
Well, he's not. I don't think he's going to come out and say, you know what, Apple, Disney, boy, oh boy, we better watch out. We better lower our expectations. That's just not Reed Hastings. That being said, down the road, a couple years from now, I think there could be a significant impact. Within the next year, I don't see those two really making much of an impact on Netflix.
Here's the way I read that. What Reed Hastings says in a public comment and what he's saying back in his boardroom are two different things, I'm thinking.
No, I think it's a good point. Yeah, you're not going to come out and, scare the children per se, but you're really going to, you're going to make the decisions to kind of handle this more crowded space as it goes forward. But at the same time, you are, at least as an investor, if you're an investor in Netflix, you're happy to hear that he doubts it's going to be a material impact, at least for the time being. But let's move on to United Airlines. We did have a trade there that I think we may have something we have to do here, Kevin. We sold the Iron Condor. We did it a little bit wider than we normally do, more kind of reflective of a strangle, Scott. We did it about $5 wide, and we collected only about a little over $1. And when you're seeing what United Airlines has done so far, United Continental, it was inside the expected move. This is the kind of move that you want when you sell that kind of a trade.
Sure, and you know what? Good earnings, stock is up nicely, but with the strikes that you set up here, you're sitting pretty. You got one day left to this. So my question to you is, do you let this go till the end of the day tomorrow because we're sitting right in your sweet spot? Or do you say, you know what? I've got some really nice profits in this. I'm taking my risk off.
I'm frankly pretty surprised that the 81 put with only a day and a half to go is still trading 12 cents. Right? Now, I understand why the 90 call is trading 31 cents because we're only a half a dollar away from that strike. Because this is a wider Iron Condor, I think you trade it fairly aggressively here and take your profits and move on. You had a nice day. You're having a nice day, $141 on a one lot. I think you take it and go because you got another whole day here. You've got all day Wednesday and all day Thursday, and you got a $5 spread here. So you're not void of risk here.
Yeah, that's the key. Even though it's synthetically Thursday because we have the holiday on Friday, I tend to agree with Kevin just simply off percentage of what you could make. We're well over 50% of the width of, as far as what we collected. I think this is one that you go ahead and you take off.
I agree with that, especially because it's a $5 wider. You could wake up tomorrow morning and they could get an upgrade and you see the stock up another $3-4 or something, and then it just blows this out of the water.
Right, exactly. Then you turn a winner into a loser.
Exactly.
And so we'll go ahead and at least route those short strikes to take the risk off. But we also have to look at one more before we get into some new stuff here. Kevin, can you pull up IBM? IBM moved a little bit more than United Airlines. So what we did in this one is we actually sold the Iron Butterfly. So we sold the straddle, and I believe we bought $10 wide wings, and we collected around $6. And so this is one that's also, it's a winner. Just simply because we saw that premium crush and it was inside the expected move.
Yes. And actually the stock did get down to about 137 this morning, which was just about at that move. It's rallied back somewhat, but yeah, you're right in the sweet spot that you need it right now.
And so, Kevin, when you're looking at one like this, you do the similar with 1 day to go. Well, do you wait or do you go ahead and just take this off because of the risk, again, being a little bit more, since we're a little bit more aggressive with our strikes?
Here's a great use of the Analyze tab here, and you can see where we are based on where it's trading. As you can see right now, it's trading 141. If you go to the Analyze tab, that's about right here. right? Right in this range right there. So yeah, right now you are in a profitable zone, but this is another one. I think because of the width of the strikes and the risk you have, I think you take your profit and get out.
Especially given it's gonna be moving around with the market and volatility post earnings as the market processes this, because it is, as you mentioned, Kevin, a little bit more risk than typical, because we did a little bit more of aggressive trade, but still, even on percentage, we sold this for around $6. It's about 30% of what you could collect in just one day. I think the shrewd move here is to take it off as well.
Yep.
I think the key to remember in any sort of setup like this for an earnings event is these were trades, right? They're not investments.
Right.
They're trades. You make your trade, you've got your profit, great, move on. Move your inventory like you always say.
Exactly. Keep the account moving. We're not in the storage business, guys. We're in the moving business.
I'm glad you said it. I was going to say, what's that phrase you always say?
That's right.
Kevin, let's pivot to the next thing. This is going to be more pertinent to today's action, and that's crude oil. And so crude oil, it did have its inventory data this morning, down a little bit here, down about 1.4 million barrels from last week, after being up 7 million the week before. But when you look at crude oil's had an incredible run, up almost 40% year to date, Scott.
No question about it, and there are some big tailwinds still. That being said, there's still a defined range here, and yes, it's been outside of the range that we were watching earlier in the year, but to me, there's still a defined range because you have tailwinds, yet you still have the overriding theme of oversupply, even with the OPEC cuts, and you also have, the global growth issue. So, I still think that we're not anywhere near a breakout of, over 70 or anything like that, and you just still have to play a range.
And as we have the chart pulled up here, I'm sure if we had Ben Watson here, we were talking about the chart on crude oil, they'd be pointing out, the old support level that we had before that significant sell-off in the second half of the year kind of will function a little bit as a resistance here as we inch up closer to it. It's around 64, 65 where we're at right now.
It should.
In crude oil now, we have a back spread on, something we don't always put on this show, something with a little more, something that has to be defended. So here you go. I'm going to show you guys what we've been doing while we've had this on. Here's the original position we put on. We sold 5 futures and bought 10 of the 64 calls. Since then, we have scalped 40 cents out of a future, sold it at 63.90, bought it back 63.5. Sold it at 64.60 and just bought it back now at 64.10. So as we're waiting for this position for a big move that we think is coming, we're adjusting this position by hedging the gamma and scalping money out of this position, fighting the negative theta that this trade has. We talk about positive theta a lot on this show. This trade and the curvature that it has, as you can see, this has negative theta. So it's something we constantly have to be defending.
And risk profile wise, we played this for a bigger outsized move given where we were in the move that we've seen so far. But this is a straddle, if you're looking at it. You need the outside move, and that's why that theta is really working against us. But we talked about this when we put this on, Kevin and Scott, this is not an investment at all. This is a very actively managed trade that you need to have your eyes on if you're watching something like this, example-wise. And we did it in pretty decently big size so that we could manage it a little bit more effectively as an example.
Scott, Prosper Trading Academy. How often do you, because this is really in many ways, it's the opposite of a lot of retail positions, right? How do you guys deal with a subject like this one?
So when you have a back spread position like this, which is basically upside down from the vertical, you are looking for the outsized move, Alex, like you said, or you're also looking for a lot of this, a lot of back and forth, so you can scalp your position like what you said, Kevin. You can sell it when it goes up, buy it back when it goes down to defend against that premium. So it is that is the one, red flag about a back spread position is the premium, is the theta decay that you have to defend against. So you have to be very careful, you have to be very diligent, and hope that you get these gyrations and while you're waiting for one of those outsized moves.
Yeah, and that's reflective too, even just looking at it here. This is a long Vega position. This benefits from volatility in this particular name.
It benefits in front of curvature of the option position, which you're getting shorter on the downside, longer on the upside. What's the cost of having that curvature? Theta.
And so, Kevin, when you're looking at something like this, obviously it's an existing position that we still have within the portfolio here. You have done a couple things to kind of manage it and manage that theta decay that we've seen working against us. Is there anything you're doing right now as far as reducing the position? Has anything changed as far as the original idea of why we put this on, leaning a little bit to the short side as we're leaning on the short futures, buying those upside calls, correct, here on this? To defend that 2-to-1.
Actually, the calls we're long are the 64s right here at the money. So in terms of, as you can see, we are short 5 futures. We're long the June 29 days to go still, 64 calls. So long 10 calls, short 5 futures. Kind of the opposite of the position we put down at 57.5, where we bought futures and bought puts. And Scott, one thing we were talking about is, depending on the direction you think the future may go, you should be long or short the future, right? When we thought oil had a chance to rally, we bought futures and puts.
Correct.
When we think it has a chance to correct and go down, we sold futures and bought calls.
Right, and that's basically creating what's called a synthetic position, because calls can equal puts, puts can equal calls when you trade that along with either stock or the future. So absolutely, based on the direction, Kevin, that you said, that's where you want to be long the equity and then short, an option against that.
Yeah, and we talked about, again, I can't stress it enough, this was a bigger size trade, being 5 futures. In terms of notional value, this is a large trade with the leverage behind futures. You can do it much smaller. You can even use the /QM, which is the mini contract, and just do 1 CL options contract against that in terms of doing things to make this even a smaller trade if you're following along.
Remember, 1 by 2, 1 future by 2 calls will give you the exact same graph, just the numbers will be smaller.
Absolutely. And so, Kevin, again, we're leaving it here, from what I understand, unless something has changed fundamentally in what you're looking to do. We're right kind of in that sweet zone. We're going to continue to manage that as we go forward. But there was one more thing that I wanted to pivot to here before we have to take a break here, Scott, is United Rentals.
Yes.
And so this company is, in a way, a barometer kind of how the economy is doing, given how much it has to do with the industrial space and manufacturing, everything to do in that space. And it's had an incredible ride over the last year, from the highs to the lows to even this year, if you look how much it's kind of gyrated, to use your word. Right now, we're up 20% year to date. Its competitor, HRI, is up 57.5, but we're off the highs that we put in this, a couple months ago pretty significantly too.
Huge. And I look at this going into earnings here, and yes, this really is a good barometer of the overall economy, but I look from a technical standpoint here, and I see some lower lows, lower highs coming into earnings here. So personally, I like a short play going into earnings, but I'm not overly aggressive on the short side. So that's why I would look to a calendar spread and make sure that if I'm looking at a calendar put spread, that I'm selling something around the expected move. And I believe the expected move here, we can pull it up, is somewhere between $7 and $8.
$7.50.
There you go. Okay. So I'm looking somewhere around the 118 strike. Actually, I'm looking at selling next week's, not tomorrow, because I don't want to have the risk of a one-day move here. So I'm looking at selling next week's 118, 117 strike, and going out a few weeks after that to buy the same strike here.
And this quickly to kind of price that out, I'm just going to see where that's trading. People are following along. So you're saying about the 118, sell next week's, and then
by like the May
3rd.
Yeah, May 3rd, even May 10th.
And so right now about 45 cents.
Not overly expensive.
And so this is one, again, you got to get that down move. So it is conviction in terms of a direction, but you're limited to what you outlay as far as your debit. So it isn't a strong conviction in terms of, if you're wrong, you're not risking much more than what you spend.
And it's as much a volatility play as it is the directional play also, because the options for next week are significantly higher from an implied volatility standpoint, just because of earnings tomorrow, or coming out for the move for tomorrow, than they are for the following week or even the week after that. So yes, I want the downward move. I'm looking towards that strike here, but there's also a big difference in volatility that I'm looking to capture.
Yeah, and so this isn't the most liquid name either. So it's one to kind of, trade it smaller than normal maybe, very conscious of this, as it'll probably be liquid in terms of markets when it's kind of in play as it is right now, but be conscious of that. Maybe if you're trading things, that are a little bit more narrow in terms of bid and ask spreads, typically be conscious of that. This definitely working on the mid prices. You're seeing how wide this iron condor is that Kevin's building out right now. And when we're looking at something like this, I actually was looking at some trades too, and I kind of looked at the calendar market as well, just because there isn't a ton of premium in these spreads, but if you do sell both sides, it gets to a little bit more attractive in terms of how much you're collecting in terms of width of the strikes and risk.
Right. You know, our general theme is if you can get 30 cents and above for a $1 iron condor, that's not a bad return. Now we've got a $2 iron condor here that I gave plenty of room to, and we're getting about 65 cents. That's not bad. I mean, for someone who wants a one-day trade where you think it'll be inside that move, right? Now we're short the 118 puts and the 135 calls. So we gave it a little wider strikes. We went $2 strikes, and we got a 65-cent credit.
Yeah, and so as you said, we have about a $7.50 move, and we look at where volatility is. I think that's always the key. If you look right here into today's option statistics, it's 48th percentile, but we've stressed this more than a few times on this show, Scott. You have to discount that down move that we saw in December, as that skewed some of these numbers up. And as we see on our chart right here, that really does show it would be a lot higher if you took out that second half of the year there, which you can't discount it completely, but you do have to be aware of it. But when I look at something like this too, just looking at the chart, setting up what Kevin's talking about from an iron condor standpoint, we're right in the middle of the range that we've seen over about the last 6 months. If you don't have a strong directional bias, this is a trade that takes advantage of it staying range bound. And if we look at what's happened, you know, even with a Netflix, sure they're different companies, but this is kind of the theme so far this earnings season has been inside the expected.
And remember, this is one day. Right? All you have this on, 65 cents, you've got one day where you need to stay inside that range.
And so as an example trade, this is one that winner or loser, you got to look at this tomorrow morning just with expiration being at the end of the day.
No doubt about it. And that's why in the calendar, I went to one further week out as my short. But for for an iron condor and you think you're just playing that move, yeah, you do the one dayer.
And so Kevin's going to go ahead and route that iron condor 4 times. We're working it at 72 cents, which is the mid price. If we don't get filled there, we may adjust it down, but no rush at this point right now, Scott.
That's a great point, Alex. And that's something that I tell the students at Prosper Trading Academy 50 times a day. There's never a rush. Because you know what? If we don't get filled at the price we want to get filled at, there's always going to be another trade to make.
And not to mention the ebb and flow clearly
doubt.
creates edge in these markets.
One of something Kevin stresses countless times on this show and at different points, you always got to kind of chase that penny whenever you can. But hey, Scott's going to join us later on the show. Thanks, Scott. But we're going to take a quick break. Coming up, Face Off. Ben Watson's going to join the show from Utah to talk Skechers. Stick right here on the TD Ameritrade Network. Fast Market. We'll be right back. Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hincks, and we got Scott Bauer back in the studio, the CEO of Prosper Trading Academy. We were just talking a little bit about Nike there in the break, as we're going to go right into that, just because it's what we just talked about on cash tags. It's in the news still a little bit with, I mean, that Tiger news is huge.
Well, it is huge, but is it really huge to the bottom line? Maybe it is.
Well, I'll tell you what, if it's 22 million, the number that they reported, that's a rounding error.
Yeah, exactly.
Right?
It's huge in terms of exposure. Yeah, again, is it a finance-related story?
Right.
Not necessarily, but it does give them a little bit of a bump. Likely we were just pointing out that the mock turtleneck Tiger was wearing instantly was sold out the next day. It will make a little, is it material? Remains to be seen, but it's a great story for Nike, great story for comeback in sports. But from a trading standpoint, you're talking about a stock that's had an incredible run over the last year, and it's within striking distance of its all-time high, which it set not even that long ago, just on March 19th.
So I liken this to what happened about a month ago or 6 weeks ago with the Zion Williamson issue when he blew out of his shoe and the stock got hit on that. Buying opportunity because that was the market overreacting emotionally. I kind of see this on the same thing here. I'm not saying that Nike is not a great stock, can't go to 100, maybe more than that. But in the short run here, I think approaching these all-time highs where there's some resistance there based on more or less the news of Tiger Woods winning the Masters, which was one of the greatest sports stories of all time. I like a short-term short in Nike right now.
And remember, here's the thing. Remember, Nike's earnings comes almost at the end of the quarter. So we've got a long time to go before their earnings will come into effect. So the question really is, how do you want to trade Nike right now? And I'm kind of with Scott. I think you do something to fade the move that's moved up here, because think about this. Lululemon, Skechers, traded relatively low PEs. Nike's a 34 PE, not cheap.
And if you compare it to how it's doing, some of its competitors and also companies that are related to it, you have Under Armour up 19%, which is what Nike's up 19% year to date. And you have Foot Locker, which is just so exposed to Nike, also up about 19%. But when you're looking at a trade as far as idea generation, you're leaning as far as direction a little bit bearish. You know earnings aren't anything you have to worry about for a little while. And you have IV percentile around 20%.
Yeah.
It's fairly low. But when you're looking at something like this, do you give yourself a little bit more time than typical because you don't have to worry about earnings announcements? Or are you still looking to maybe a week or two out and looking for that kind of that short-term turnaround because you're kind of playing to fade that move off Tiger Woods?
I'm looking probably 2 to 3 weeks off to fade this move. That's exactly what I'm looking. And like Kevin pointed out, earnings are at the end of the cycle. I want to do something before earnings. This is not an earnings play, and it's really just an emotional play off the market.
And directionally, as Kevin has kind of built in here, he's selling the vertical call spread for about 68 cents on $2.50 wide. That's about what we look to collect, about 1/3 the width of the strikes. This is going to give us a little bit higher probability of success because it gives us a little bit of a window to allow this to run up a little bit more before it hits that 90 strike.
Only 65%, but remember, we're taking a short position for a reason because the stock's already high.
Absolutely, yeah. Like I said, just within striking distance of that all-time high. Or do you look to lower volatility? Do you look to the put spread as, buying that debit spread, trying to take a little bit more of a lean as far as direction?
Right, and this is our conversation that we had earlier off mic, Kevin, between being long premium and short premium. I would look to buy a put spread because of the low volatility, because of the lower amount of premium. So I'm going to look out. What is the market expecting for an expected move going out to May 3rd, 10th? You had the 17th up there, and really play it off of that expected move.
Right. So here's, if you are someone that likes to sell put or call verticals, here is a moderately aggressive, about 66% chance of being out of the money to fade Nike's move. Now, if you're listening to Scott and this discussion and say, based on the implied vol of this name, maybe we should be looking something in the long premium section, right? I mean, look at the 20 IV. Then you've got to go something in either the calendar or the diagonal family. Now, the question is, with 88 as the range here, where the stock's trading, what strikes do you want to choose in, say, a downside calendar spread? 88? Are you going 85? I mean, 85 is about the move all the way out till May. It's just a little over. It's almost $4.
Right. So I was looking at the May 10th, which is about a $3 wide move, which roundly puts me to the 85 target. So I'm looking at maybe an 87, 85 put spread, maybe even 86 and a half, 85.
Are you buying the May 10 or selling the May 10?
I want to buy the May 10.
Okay. The 85 line?
And short. No, I want to buy a higher strike there. If we're going to do a diagonal, I'm going to buy the higher strike on the May 10th and sell the next week's, maybe 86 or something like that, just to give me that diagonal, or just a regular put spread. I could do the May 10th and just put on the 87, 85 or 86 and a half, 85, just vertical put spread.
And so if you just build out that real quick, just so we can talk about it briefly here before we move on, this really just comes down to how strong is that conviction on the direction? Because if you're a little bit more directional in terms of how much you want to lean bearish and you really think you're going to get that move soon, this has potential to pay off more for how much you're risking. The risk reward here is going to lean a little bit more for the payoff in your favor if you're right. The trade that Kevin put in, a little bit more strategic, gives you room to maybe be wrong, or if not necessarily wrong, just maybe not perfectly timed.
Difference between the long put vertical and the short call vertical in this case is the Scott's trade, the long put vertical, you have to have movement. You need movement lower than 86 and a half really for that trade to break even.
Which is, it was an excellent point. Let's pivot here and let's talk about another apparel brand, another shoe brand. Let's talk about Skechers. And we just talked about Skechers in our face-off segment, and we talked about how it's got earnings, but we talked about how it tends to move significantly on these earnings, and it gaps quite a bit. And we even pointed out the market maker move about 430 right now on a $35 stock. That's over 10%.
Well over 10%. And this is one also that you typically see a big move right after the market when they announce their earnings. And then you come in the next day and maybe that move is not in the same place, almost like what we saw with Netflix. But you're going to get a big move here in Skechers. At least historically, you're going to get that. And I like it. You know, this is not an outlier move to get a 10, 12, 15% move in a stock like this.
Yeah, and it's not, again, it's not the most liquid name, and it does get a significant portion of its movement in terms of its stock price during these announcements, and that's why you see those gaps. But
And what I love the best about it is the illiquidity of this name and the high implied vol percentage that it's trading allows for really inexpensive one-week calendar spreads. Look at the 31. If you think it's going back down towards 31 and 30, 13 cents on a calendar spread.
So he's got the 31 one-week wide put spread built out here. So that's a little bit of a bearish lean, but you're only risking 13 cents. So even at 10 lots, only $130. But I want to kind of pick your brain on how you got this directional move. Do you take into account the fact that the stock's up 52% year to date and has climbed 27% since its last earnings announcement on February 7th?
Yes, yes, and yes.
Okay.
Remember, the last time it had earnings, it gapped to $31 from where it was. Now, if you think it's run too much and may come back here on a medium to average quarter, then it's $31. It may go right back there.
And we talked with Ben Watson in our second segment here, and when we did the face-off, and he pointed out that's roughly where we have a support level too from that previous gap. So if you do get that downwards move and that support holds, you could be looking at a chance to kind of pin this right on the nose.
31 is one of those magnets. You know, stocks have those defined areas. In Skechers, it's 31. If you go, can you go back to the chart 1 second? I know you just discussed it with Ben, but if you go back here all the way to last July here, you can see where that gap was last July. Where is that at? Comes in at 31. You can see the high in October, November. Where is that? 31. You can see the high.
A lot of similarities.
Yeah, I mean that's going to be a magnet. So if there's anything negative on this report here, 31 is going to be a number the market's looking at.
Which, when you see something like that, that's the first thing you're thinking of when you're looking to set up a trade like this that really relies on getting that directional move right, but really kind of pinning it on the nose. But let's look at also, just for idea generation, we'll go ahead and route this, but just so people following along at home, this is again one that you're gonna work at the midpoint because of that illiquidity, and you're in no rush to fill. But look at that differential between this week, 213% implied volatility.
All I know is this, that has to be sold one way or another.
Versus
You have to take
99,
advantage of
which
that.
is high in its own right, but 213% implied volatility just for one day. That's what's allowing us to do this for such an inexpensive debit.
Right, and you know what's really it's very interesting in this one is you mentioned this. Most of the time we see the move on an earnings report. If you look at the expected moves here now, going out 1 week, 2 weeks, 3 weeks, 4 weeks, you're going to see that move. It's almost non-existent from what it is for the market maker move this week. If you go back to April 26th, I think the move is only $4.50. If you go to May 3rd, it's like $4.80. The one-day move is $4.30. So this is an opportunity to really capture something on the one-day move.
A 31 calendar spread, a put calendar, and a 39 call calendar, same price, 13 cents.
And
you
so
can pick your direction.
Or you could play them both.
Play both.
Yep.
Yeah, do you think to do that if you don't have a directional bias at all? Do you just say, hey, it's 13 cents, do I put on 5 of each as
Think
opposed to
about it.
10 of one?
5 of each is $130 total invested. You can't really do much better than that in terms of low entry into a trade.
It's called a strangle swap.
Yep.
Yeah, and as Scott had mentioned, though, that I think it's important to point out is the market's not completely, naive to the fact that this stock's going to move significantly on this earnings announcement and maybe just hang out in that area. The volatility next week's going to come out significantly as well.
Yes, it is.
And so when you're looking at something like this, is set the expectations. If you had this if you got the move you wanted and you got it at 25, 30 cents, that's probably a point that you're looking at this as,
I'm out. Oh, for sure.
Absolutely.
For sure.
Yeah, I mean, this is a short-term trade. You get a move towards your strike, you exit.
And so, Kevin, do you want to just stay on the put side, or do you want to route a couple of these calls as well?
How about we do 10 puts and 5 calls?
There you go.
Just as a little hedge of our hedge.
And we maintain a little bit of a bias to the downside as the chart kind of was showing, but we're also, pointing out, if we do get that move up, as the stock was recently upgraded and has been strong, we'll continue maybe that immediate or intermediate uptrend as far as what we've seen in the stock price, Scott.
So in a setup like this where you are playing both sides, the worst thing that can happen is no movement in the stock, and the stock just stays in the middle. You want the stock to move to one of these strikes.
Which it does have a history of doing. But hey, we got to leave it right there, guys. Thanks to Scott Bauer, the CEO of Prosper Trading Academy, for joining us today. But that does it for Fast Market. Tune in tomorrow at 10 a.m. Central right here on the TD Ameritrade Network. Have a great day.